This is the business of sports.
Sports are the greatest unscripted show on earth.
The next generation of players really grew up with tech and believe in tech.
Your face is your ticket. Your face is your wallet. Your face is your access to a club.
These are such iconic and important buildings for businesses, for fans.
COVID was one of the best things that ever happened to golf.
The NFL is a bulletproof business.
Racing's unique because there is absolutely no reason why we can't compete with the guys.
Come on, is pro pickleball real? Are people really going to tune into this?
If you're playing Moneyball with a huge bag of money, you're going to be really, really good.
Bloomberg Business of Sports from Bloomberg Radio.
Hello. This is the Bloomberg Business of Sports, where we explore the big money issues in the world of sports. I'm Michael Barr.
I'm Damian Sassower.
And I'm Vanessa Perdomo.
Coming up today, we'll talk with Vice President and General Manager of Futures and International for Robinhood Markets about his company pushing into prediction markets.
The goal that I was brought in for was to begin to offer not only our U.S.-based product internationally, but also to develop a futures product here in the U.S. that we could offer out to our retail investors. And in that pursuit to offer, I will say, the futures product is where we developed an opportunity to offer prediction markets out to our end clients. And so a little over 12 months ago, we launched prediction markets on the presidential election. And then from there, we've continued to build that product out.
And we are looking into our crystal ball for 2026. Our team of sports business reporters here at Bloomberg News got together to share what they think is in store for the sports world in the new year.
And you're going to want to hear it.
Mm-hmm. Psst, we know somebody.
We're pretty smart.
Yes. All that is straight ahead on the Bloomberg Business of Sports. But we start with a big story in the world of sports investing.
And it is a big story. Michael Barr, private equity giant KKR, is working on a deal to acquire Arctos Partners, a deal that values the sports-focused private equity firm at about $1 billion.
For more on the deal, we welcome Bloomberg News private equity reporter Allison McNeely in the studio. Allison, welcome to the Bloomberg Business of Sports. Thanks so much for joining us.
Thank you for having me.
Now, what happens when this deal is set upon the landscape? Will it change everything in sports?
It's certainly a significant development in terms of the institutional capital that is quickly swarming into seemingly all areas of sports. KKR, one of the oldest private equity firms in the United States, really in the world, and kind of the granddaddy of the asset class, if you will. They have been investing for a few years now, sort of around the edges of sports and media and entertainment. But this Arctos deal that is on the table with the leagues, this would really move them in a meaningful way into minority team ownership and, put another big money player in the business of owning sports teams.
That's exactly what I wanted to ask you, Allison. Has KKR been looking to get more into exactly that, like you said, into team ownership? Is that exactly where they looked at Arctos? Has it been something that, because you said they're invested in gaming and other things around, but team ownership is a completely different ballgame.
It is a totally different ballgame. So KKR is really, as I've heard from sources that I've spoken with, they're really kind of looking at all the opportunities. So obviously Arctos deal would put them into team ownership, but they're looking at stadium financing, they're looking at media rights, they're looking at lending. They have been invested in some of these ancillary sort of services businesses. So they're really kind of assessing the landscape. I think the consensus view in the private equity industry is just that sports is a huge opportunity. And there's a lot of money to be made in it, depending on kind of which angle you tackle it from.
Consolidation, right? I mean, we know that, the NFL, has basically limited the number of teams or the stake sizes that private equity firms can take and, professional franchises. Do you foresee that this type of a deal, consolidation in the industry, can create some issues there, can perhaps create some forced liquidation, so to speak? Is that a risk?
I'm not sure that that's a risk at this point in time, but I would maybe not be the best person to comment on that. What I think is happening more than anything right now is folks in private equity from the investing side are kind of everybody's looking for their way in and how they sort of tackle that and who might be willing to sell to them or who might be willing to come into the club is kind of what's most top of mind for these managers.
I remember back in the day, here I go, back when you could buy the Detroit Tigers for $36, and if you had the sponsorship, you know what, see, and if you had the sponsorship from Fred's Bait Shop, you were good to go. Now, not only owning the team means something, but you have to have the sponsorships as well to make a whole bunch of money.
Mm-hmm. And the sponsorship thing is a really interesting question, because one thing that I've heard from speaking to people kind of around sports investing is the potential for conflicts is a really, really big issue for them. And certainly that's an issue. I shouldn't say issue, but that's a question for this deal. And right now we're hearing that this deal has gone to the leagues to start to get their approval. And so they're kind of, as I understand it, running checks to basically find out, is there some athlete somewhere who's, a pitchman for a KKR portfolio company that they're not aware of that might create some kind of potential conflict. So yes, there's tons of money to be had in sponsorship. And, that obviously plays into the valuations of these teams and these assets.
And we are speaking with Bloomberg News private equity reporter Allison McNeely. Allison, when you're just exactly on what you're talking about, when they're talking about how these leagues have to run checks, I mean, Arctos is into the NHL, the NFL, the NBA, all these different leagues. So with a deal like this, and they've, they're agreed to acquire it, but all these leagues have to say yes. And how long does something like that take to get over the line?
So that can just depend. I've heard that it can take months. So I don't know that we know, or I certainly don't have any reporting at this time that indicates exactly how long it might take. But, it can take several months. It can be, a very complex and certainly a thorough process.
Considering also KKR's vast portfolio, right?
Yeah. They have $723 billion in assets under management as of the end of the third quarter. They're one of the largest private equity firms in the world. They're constantly getting involved in new areas of investing. And, you got to run the traps and see, if there are any conflicts.
All right, so I get it. So, I mean, basically the acquisition goes through. We have a bigger, better Arctos with some better institutional capital behind it. What comes next? I mean, they own PSG, they own the Devils, they own professional football teams. I mean, where, do they go next? What do you think comes next for a firm such as Arctos?
So for a firm like Arctos, the value proposition that they bring to KKR is essentially giving them an entry point into all of these leagues. As you noted earlier, they're already invested with teams in the major four leagues. So they kind of have boots on the ground. And that's a real competitive advantage, because some of the other private equity firms who are in sports investing, there are certain leagues that they can't invest in because of, there's one guy at the firm, the co-president, the co-founder, something like that, who is a investor as a person, as an individual in a sports team. And so therefore the investment firm, it can be very tricky for them to invest as an institutional investor in the sports team. And so this deal potentially, because Arctos doesn't have those issues, and because KKR, to my knowledge, doesn't have those issues, what this really means for Arctos is they now have big, money giant behind them. They kind of have clearance in all the leagues already. And, they have access to the really sophisticated operational and investing capacity of KKR to kind of grow into all sorts of other areas. Certainly, when I talk to people who invest in sports, the two themes that come up over and over again are college sports and women's sports. So you have to wonder, are they going to start doing deals in that space? I don't know, but that's certainly a question that would be a good one to ask.
To bring more money into women's sports. I'm all about it. Right? You had just said something on that, is that not every, private equity is allowed to invest in certain leagues. In the NFL, there's only about 6 or so that are allowed to invest, and Arctos is one of them. But KKR technically wasn't. So is that something else that they have to check before? Do they now have to be approved as a official partner?
Exactly. Yeah.
Right.
So by becoming the owner of Arctos and sort of absorbing it into their firm, KKR now has to get all the approvals that Arctos got before. So that's exactly what would happen.
Right.
Now, I want to compare two different types of owners especially in the NFL. One, you have Jerry Jones, owner of the Dallas Cowboys, and he's going to do it the way he's going to do it. Then you have other teams where you have a lot of private equity owners also involved. Can a guy like a Jerry Jones compete with a team that has a lot of money to it?
I have no idea.
No, but that's actually a really good question because it has the potential, as more and more of these huge money managers come into sports, it has the potential to fundamentally change the landscape. They are so deep-pocketed. KKR and their peers are bringing in fresh dollars constantly. We haven't even talked about wealth, private equity firms are trying to reach individual investors now, and they're creating all sorts of investment products to market to people in their brokerage account and their 401k account. And so, if you have all that retail dollars coming in, as well as your pension funds and your traditional investors, they just have a ton of money coming in all the time that they can put to work in, potentially in sports. Allison, we've been talking a lot about how this is a win for KKR and getting into team ownership, but how big of a win is this for Arctos as the valuation proposition that they got, and how big of a win is it for them?
I mean, I would say that, the individuals at Arctos with equity are probably happy.
Was it $1 billion or $1.5 billion valuation that they got?
Yeah. So the valuation is around $1 billion, but the way the deal, as I understand it, from speaking with people who are familiar with it, is that there are sort of what they call earnouts or incentives. And basically, they bring over the senior team, and then depending on how the business performs, that can kind of potentially boost the valuation. And so, we're talking
there's
about
a kicker in it for Ian Charles is what you mean. Yeah, no, I mean.
Yes.
Well, I mean, let's be clear. I mean, it's going to be an interesting scenario to say the least. Allison, thank you so much for joining us here today on the Bloomberg Business of Sports. Allison McNeely, Bloomberg News private equity reporter. Thank you.
Thank you for having me.
Up next, Robinhood's move into prediction markets.
Say, we got another old friend of the show. We're just piling them on all this week. For Damian, Sassower, and Vanessa Perdomo, I'm Michael Barr. You are listening to the Bloomberg Business of Sports from Bloomberg Radio around the world.
This is Bloomberg Business of Sports from Bloomberg Radio.
This is the Bloomberg Business of Sports, where we explore the big money issues in the world of sports. I'm Michael Barr.
I'm Damian Sassower.
And I'm Vanessa Perdomo.
Robinhood is pushing its way into prediction markets, and here to talk about the company's expansion and growth in the space is J.B. Mackenzie. He's Vice President and General Manager of Futures and International at Robinhood Markets.
J.B., welcome to the Bloomberg Business of Sports.
Thanks for having me.
You are Vice President, General Manager of Futures and International Robinhood Markets. Tell us about that.
Yeah, I joined almost 3 years ago to the day, and the goal that I was brought in for was to begin to offer not only our U.S.-based product internationally, but also to develop a futures product here in the U.S. that we could offer out to our retail investors. And in that pursuit to offer, I will say, the futures product is where we developed an opportunity to offer prediction markets out to our end clients. And so a little over 12 months ago, we launched prediction markets on the presidential election. And then from there, we've continued to build that product out. But it was all with this idea of creating the one-stop shop for everybody to be able to trade, that sort of financial super app that our CEO Vlad has been envisioning and pushing us to develop is what we started to create.
And I mean, what a year it really was, right, in 2025 for prediction markets. It feels like, back in 2018, the big new word was sports betting, and it was all of this stuff. And we talk about it a lot on this show, sports betting. But now it feels like prediction markets is this new hot thing, and everyone's talking about it. Tell us about how they differ from each other and why you think that prediction markets are getting so popular as a medium right now.
No, Vanessa, absolutely. I think it's a great question. And I think the first thing I would start off with is that prediction markets, even just overall, whether it's sports or not sports, they actually use the identical structure as equity, options, and future markets. And what that means is it's a centralized order books where bids and offers come in from other participants in the markets. Unlike, let's say, a sports book where the sports book sets the line and creates the market, and then you trade against the sports book. So there's sort of this inherent conflict, right, where the sports book is actually giving you a price and in a product, and in some cases, it will reap a reward based upon you not being successful in that trade that you make. So I think that's the first thing. I think the second area that's really important about it is with that centralized order book comes transparency and consistency. And what I mean by that is whether you're a customer in New York or a customer in Illinois from where I'm from, you get the identical price for the trade that you're making. You see the same thing. The cost is the same. The price is the same. It's transparent for all the participants that are in the market. Again, just like what we see out of the traditional equities and futures and options markets. And then I think the third thing that's important about this is a CFTC or federally regulated product. So we follow very strict rules that have been put into place for whether that's opening accounts, KYC, AML, money movement, oversight, et cetera. So really, those are the kind of the three key differences where you see on the other side of the sports, that's much more oriented towards state-by-state regulation.
JB, so, you have to help me out here. You're mentioning central limit order books, CFTC regulated product, and yet, we see, some markets on whether or not Maduro is going to be ousted last year and paying out, I think there was a news article just the other day I was reading $400,000 to someone who was, placing bets, into, what happened, just recently. Curious to hear how you manage that risk. How do you manage that two-way exposure? Are there, two sides to the trade? Talk to us a little bit more about that.
No, Damian, I think that's a great question. And with all of these markets, it is a two-sided trade. So Robinhood acts as an agency market, meaning what we do is we allow our clients to access an exchange where in this case, the buyers and sellers come together, right? So we don't participate in the market. We don't make markets. We don't take positions. There's no risk on from a Robinhood standpoint. The way in which that trade occurs is there's a person out there, whether that's a market maker, whether that's an individual, we don't know what that is, who basically said, I believe there's X percentage chance that this happens. And on the other side is another person who says, I believe that I agree with that and I want to take the other side of that trade. So it's actually interesting. It does work just like if you think about a traditional market that's out there where it may feel a little bit awkward because of what it is you're trading. But at the end of the day, it's someone who believes that the probability of this happening is, let's say, at 51%. And that opposite side is willing to say, I'll put that price up there and I'll actually make a trade for it. So it's really creating the efficiency of the overall markets coming into this decision-making process, but we're removing the conflict that's in place, which is one side is actually hoping that you are incorrect in that trade. In this case, we look at you as saying you can buy and sell and come in and out of that trade whenever you want. It has no impact on our book or how we do it because we don't take the opposite side of that trade. All we're sitting there saying is here's products that make sense that traders want to trade and we give access to them.
Well, JP, how about those low probability outcomes? I mean, we're talking about Maduro. That was a 50-50, but, there are some others, I don't know whether a UFO is going to land on Earth next year, but talk to us a little bit about how you guys manage risk around like 1% to 2% or less probability type outcomes.
So first off, these are fully collateralized products. And what that means is that you actually have to have the money in your account to place the trade. So first off, the risk that comes into play here is to the end user that does it, right? So if they decide to buy something at a 2% probability, that's just going to be multiplied by the money they have in their account. If they have enough of that money, they're going to be able to place that trade. That also being said is we don't offer every single product that's out there. So some of the products you're talking about, some of them we do and some of them we don't offer. We actually look at those products and say to ourselves, is there enough liquidity and or interest in that product? The vast majority of the products that we look to offer out there are not running at a 98.2 type of probability until the event becomes closer and closer to occurring or coming to resolution. For us, what we look for are those products that are out there that have the opportunity for the market to participate in them at a probability that's greater than that. Now, some cases that works and sometimes it doesn't. But what you do see is very much like zero-dated options. The probabilities compress quite a bit as you get closer to the end of that day, for the example of a zero-dated option. But in these events, as you get closer to the event coming to fruition. So pick a sport, the probability at the beginning of the game is going to be much wider than it's going to be much tighter, meaning sort of 50-50, 60-40, 70-30, than it will be at the end of the game when the outcome looks to be coming to its finality, where the score is, team A is beating team B. Same thing holds true with something like the Fed rate cut. The Fed rate cut today is going to be much different on a probability than when it will be as you get closer and closer to when they make that announcement.
We are talking with J.B. Mackenzie, Vice President and General Manager of Futures and International Robinhood Markets. You guys, as we are now in the NFL playoffs, you guys rolled out the custom combos. What is that?
So basically what they are is the ability for the customer to be able to select specific components and create their own trade, similar to what in the sports world is a parlay. And what that means is I can go and select, let's say, I grew up near Buffalo, so I'm going to be a little bit of a homer here. So I'm going to take the Buffalo Bills, and I want to also pick Josh Allen. He'll have 2 touchdowns. I can go and create that combo together where it'll price into the market and provide me back a probability of that outcome, and I can then make the decision of whether or not to place that trade. So we just started rolling this out this week for the first week of playoffs, as you mentioned there, Michael. And we really think that this is an interesting product because we're seeing more and more of our customers wanting to go build this as part of their overall portfolios. While we're starting in the NFL, we think that this will be a product that will roll out to all asset classes longer term. But right now, what we're doing is starting off specifically with the NFL playoff games that start this weekend.
JB, you mentioned there, obviously, we were talking about the combos and you guys just introducing that. One of the other things you guys just introduced was Cortex, this AI chatbot that gives you advice, right? And I'm curious what your thoughts are on these tools that are used for financial advice and things like that, other things that you guys offer, and how they're converging with the sports market.
So I think that's a really interesting question. And the way I like to think about this, Vanessa, is when I started in the markets 20 plus years ago, the only thing we had was the ability to phone call into a broker to figure out what maybe one of Bloomberg showed on the television ticker and say, I want to go buy something. You had very limited access to tools. And what's happened since then is this dramatic revolution where we've been able to get both data as well as charting and capabilities onto our mobile devices. And I think the natural progression with that has come into the AI world, where what we're able to now do is utilize AI or Cortex in this instance to accumulate information from a variety of sources and provide alerts to our end customers to tell them that something is moving that of interest to them. So while our Cortex product that we offer today is much more focused on just providing them generic information of, hey, this product is moving up or down, you see that happening already today in the overall sports world. In many different ways where there's notifications, or you even see it when you watch games with, you'll see AWS is powering a lot of the NFL statistics out there, and they're talking about the probability of a team scoring a touchdown inside the 20-yard line in the red zone, or the ability to get third down in less than 5. And that information now is so handy at the fingertips of traders. I think AI now is making it even more accessible so that you can then make great decisions. I think as you've already seen AI take over, I think all parts of the world in many ways, I think it's going to continue to play an important role when it comes into the sports world, because they can actually consume and analyze data so quickly and provide it back to you that it allows you as a trader to make a really good decision very, very quickly.
JB, you talk about KYC and knowing your client, but doesn't that become really, really difficult when you move outside of sports into some of these other prediction markets like elections, economic events, where it's a different set of players who have quote unquote inside information? What's your KYC process, and how do you protect, Robinhood from those events working against you?
No, and that's a great question, because obviously it's been in the news as of late, is how do we control or have access to make sure that people who access these markets don't have insider knowledge. And I think one of the first things I would say is that the financial services market has been doing this for decades and does a really, really good job when you look at the overall size of participation, right? So if you look at the financial services market in the United States, I mean, it dwarfs the participation of what you see in the sports world. Now, I get to your point of how do you make sure that someone that's working I'll make it up, in an election campaign isn't also placing a trade because they have some piece of information for it. So for that, what it is we've been implementing a variety of tools that we can utilize for it. So part of our KYC and AML process is we collect information about you as a person. So we know your job, your employment, we know where you're located. All that information is required for us to develop and pull through. And collect for us to be able to open up an account. From there, what we also then do is we do analysis of where you may fit in various types of credit bureaus and overall sort of LexisNexis and third-party platforms, so we get an understanding of the information you provided to us is correct and accurate, because that's one of the things that we have to do as part of that know your customer requirements.
J.B. Mackenzie, Vice President and General Manager of Futures and International Robinhood Markets. You're an old friend of the show now. Thank you, my friend, for joining us on the Bloomberg Business of Sports. We really do appreciate it.
Thanks for having me. Looking forward to coming back again.
Up next, we look at the future. What Bloomberg's top sports reporters see coming next in the world of sports in 2026. For Damian, Sassower, and Vanessa Perdomo, I'm Michael Barr. You are listening to the Bloomberg Business of Sports, Bloomberg Radio around the world.
This is the Bloomberg Business of Entertainment Report, brought to you by FisherInvestments.com. Disney reached a box office milestone in 2025, surpassing $6 billion in global ticket sales, its fifth time crossing the benchmark and first since the pandemic in 2019. A big part of it, $2 billion blockbusters, Lilo and Stitch and Zootopia 2.
This is a make-or-break assignment. Fail, and I will split you up.
Add to that James Cameron's Avatar, Fire and Ash, and 3 Marvel sequels. But not everything that Disney released in 2025 turned a theatrical profit, including the live-action Snow White and Pixar's Elio.
All I ever wanted was to find a place to fit in.
But the misses still outperformed most of their rivals' biggest wins in terms of box office dollars. And with the powerhouse lineup ahead, including Avengers Doomsday, Toy Story 5, the live-action Moana, and The Devil Wears Prada 2, 2026 looks promising. Lisa Mateo, Bloomberg Radio.
This is Bloomberg Business of Sports from Bloomberg Radio.
Thank you for joining us on the Bloomberg Business of Sports. We explore the big money issues in the world of sports. I'm Michael Barr.
I'm Damian Sassower.
And I'm Vanessa Perdomo.
Our top sports reporters, including Vanessa Perdomo, put out a special edition of the Business of Sports newsletter, looking into their crystal ball as to what might very well happen in the world of sports as we look ahead to 2026.
So the fun thing we did was we did our wrap on 2025. We gave out some awards, Asia Wilson, Athlete of the Year. That was the best one.
Gray gets it in. Wilson on the drive. The fade. You bet. You bet. Asia Wilson with .1 to go.
And then we did a 2026 look ahead, as in she might have gotten, Player of the Year, but the WNBA and women's sports are in a crisis. And that was my prediction for this year. Women's sports need to kind of pay their players. My other colleague, Ira, he predicted that private equity is not going to make as big of a splash in college sports as we think.
And here to give us the secret tip on who's going to win the Super Bowl, because I got to put some money on it. Joining us now, biggest sports predictions for the new year, Bloomberg News Global Sports Business Reporter Ira Boudway. Ira, welcome back to the Bloomberg Business of Sports.
Always a pleasure.
Biggest prediction that you hit the money on.
So I'm anticipating that this big private equity push into college sports is going to maybe stall out. And I think everyone expects that once the first deals get done, it's going to be floodgates. But we've seen a couple deals get almost to the finish line now. One a school deal between Utah and this outfit called Otro Capital, and the other more recently a conference-wide deal between the Big 12 and Redbird and Weatherford, who put together a thing called Collegiate Athletic Solutions, CAS. And both of those deals have been said to be kind of the beginning of a flood. But I think, one, those aren't done. And two, we don't really know the terms yet. And I think really the devil's in the details here. And I think by the time these get done, they may not be as exciting for everyone involved as everyone has said.
I think the thing that's interesting is that you mentioned they're not done, and everyone thinks, all of these things have been written, they're coming, it's coming, and then these deals get close, they don't get finished. In your story from this year and our predictions, you kind of mapped out exactly why they get close and don't get finished. Can you explain that a little bit more?
Yeah, I think a lot of the time these deals are negotiated first between athletic directors, maybe conference heads, and the private investment shops. And then they bring it to the board of regents. They bring it to the trustees. They bring it to the broader leadership of the school, and that's where it stops, or at least where there's hiccups, because these schools look at it and go, well, wait a minute, can't we borrow money more cheaply somewhere else? Maybe in the bond markets. Why are we doing this? Are we losing governance? And there's just a lot of questions and snags at that point. So they keep taking different hacks at it. You look at the Big 12. I think a year or so ago, they were saying we're going to sell 15 to 20% of the entire conference to a private equity firm. And then that didn't happen. And now they're saying, well, no, we're going to put a pot of money that each school, if they want to, can borrow from, right? So they keep reshaping these deals to try to get them over the finish line. And I think by the time you do that, they become maybe less attractive than everyone's imagining.
So, Ira, here's my question, right? I mean, we keep saying private equity investment. It's really institutional capital, right? And that can mean a lot of different things. It's not necessarily private equity. So my question is, are there any rules preventing, let's call it, foreign players, foreign investors from taking a stake in an American university?
What these deals are shaping up to be, you're right, they're not stakes in anything, except for in the case of Utah, it's like they create a separate holding company for the business interests of their athletic department.
Okay, I see what you're saying.
So it's like the media rights,
it's a non-for-profit, right? The university itself.
Right.
Okay, I got you.
So they say the athletic department will continue to exist. It will continue to make all decisions around personnel, players, coaches, everything like that, schedules. There's going to be a separate company over here where the money for media rights, tickets, sponsorships goes. And this private equity firm is going to help fund that company, and it's going to have a claim on some of that future revenue. And so these deals are not equity deals, and they're not even necessarily straight debt deals either. They're deals where the private equity fund says, here's some money. The institutional money says, here's some money. And we expect if you hit certain revenue marks, we're going to get a pre-negotiated share of it. So if you don't hit those revenue marks, there's money at risk for the institutional money. They might not get paid back.
So I understand how that model works for a public university like University of Utah, but there's a lot of private universities out there.
Right.
So a different model might very well work for them. I'm just thinking out loud, and you know where I'm going here. I think of LIV and how the Saudis came in and disrupted, the sport of golf. What's to stop, some player from coming in, taking a stake not in a holdco that controls the ticketing and the gate receipts, but controls the actual university itself.
Or at least its athletic department.
Athletic department, right? Which obviously is funding, in many respects, all of academia there, right? So I just want to, not all of it, obviously. Tuition dollars help too. But believe me, I can speak from experience. But that is exactly where I'm going with this. Like, is there any, kind of guardrails in place to prevent, a disruption of the American university system?
I mean, I think it's, private universities, they pretty much govern themselves, right? So they could if they wanted. I mean, I think the reality is they are facing a budget crunch. So these athletic departments are not contributing to the bottom line at the schools. They are spending more than they're bringing in.
Interesting.
And that's happening because of essentially player costs right now. There's a new rule that says they can spend $20 million a year on rosters, and they are foregoing revenue from other sources in order to funnel it toward players. And so that is hitting the budgets to the tune of maybe $30 million a year. And in many cases, they're already spending all their money as it comes in. So that's why you're seeing institutional money come in here. They're saying, look, we'll give you some money up front. We know you have a budget crunch. We're going to show you how to make more. We're going to show you how to sell more suites. We're going to show you how to do a better job with sponsorships. We're going to professionalize your operation. And when we do that, you're going to give us some of your revenue in the future.
Which brings me to the next question, a prediction you guys made in the article. Major League Baseball, they're going to spend money, a lot of money. And yes, even Mr. Steve Cohen is going to spend a lot of money because now if you want to get to the playoffs, you got to have a fat wallet.
Yeah, I mean, every year I feel like we have the playoffs, and there's one of two discourses. There's some team that snuck in there without spending a lot, and we all talk about how you can still do that, or the big money teams dominate, and we all talk about how money rules all. But I think obviously it's a little bit of both, but we've seen these teams like the Dodgers who are smart, well-resourced, have a good farm system, like they do all the things, and then they spend really big, and that is proving to be, not surprisingly, a winning formula. And I think you're going to see more teams try to do that. I think that's what Steve Cohen wants to do with the Mets.
But he has been unsuccessful in his spending, quite unsuccessful. But the Yankees need to get back to spending money, in my personal opinion. On your other prediction, though, Ira, when we're still talking about college football, because it is the college football playoff, when we're looking at the prediction that you made and looking at, like you said, how colleges are spending money, you also did this report on trying to figure out how they were spending this $20 million, and no one really was giving you information. But from what you know and what you've done reporting on, what are the feelings from these institutions now that they have to do that, and how and who are they spending the money on?
I mean, probably not surprisingly, they're spending the money on football players. They get to spend $20 million of this revenue sharing pot on their players, but that's across all teams.
It doesn't say they need to, right?
Right, yeah. And it doesn't demand that they do any. But the market for a top quarterback now is approaching $5 million. So that's like a quarter of your money right there. Yeah. So there, it looks like, at least at schools where they care about football, you're spending about $15 million of that $20 million on your football team.
Well, Ira, let's stick with football here, but let's go pro, right? I mean, one of your predictions here is that we're going to see a couple sales in the year ahead, right? I mean, I'm not just talking, private equity or some institutional capital taking stakes in NFL teams. I'm talking about outright sales, and the two teams that you flagged here, the New Orleans Saints and the Seattle Seahawks, who are right now the best team in the NFL heading into the playoffs. Just want to ask your opinion here. I mean, we've talked about this in the past offline, Ira. The NFL, they're eating the cake too, so to speak, right? With the new media deals they're doing, and with 2028 coming up, and they're going to be able to renegotiate out. Talk to us a little bit about these valuations. I think the Cowboys, if you just look at where they are now based on some of these recent deals, $14.4 billion.
Yeah, I'm pretty bullish in the case of the NFL. I think they are distinct among all sports in the U.S. anyway, because one, the audience size is just bigger than everybody else by a lot, and two, the way they've set it up with their players and the collective bargaining agreement and the way they share revenue between teams. These clubs, they don't lose money in the meantime. So you get an asset that's probably going to grow in value, and while you're holding it, you're not bleeding money. And I think that's not always the case in professional sports. So I expect these teams to keep setting records with these control sales.
Well, I'm going to add this too. I know we're running out of time, but it seems to me like private equity now is the key to all this ownership.
Yeah, I mean, you're looking at the NFL, all the leagues, they may have to keep changing their rules to allow more institutional money, simply for the reason that it's hard to find people with cash sitting around. The list gets shorter and shorter, and so they might need more institutional money just to keep the market moving.
Well, sir, we love you, man. Our thanks to Bloomberg News Global Sports Business reporter Ira Boudway for joining us.
We'll be diving into more of our big predictions for 2026 in next week's show.
What happened at the time? This is what happens when you get good conversation. That does it for this edition of the Bloomberg Business of Sports. For Damian Sassower and Vanessa Perdomo, I'm Michael Barr. Tune in again next week for the latest on the stories moving big old money in the world of sports.
And don't forget to subscribe to our podcast so you never miss an episode. Find it on Apple, Spotify, the Bloomberg Business app, and your favorite podcast platforms.
You are listening, not even the contraction. You are listening to the Bloomberg Business of Sports from Bloomberg Radio around the world.